Thank you for taking the time to meet with me today. I've just started my journey as an underwriter, and there's so much to grasp. Can we begin with the basics? What exactly is insurance, and how does it work?
Of course, I'd be happy to explain. Insurance, at its core, is a contract between an individual or entity and an insurance company. The insured pays a premium in exchange for the insurer's promise to cover specific risks, such as damage, loss, or liability, should they occur. Essentially, it's a financial safety net designed to protect against unforeseen events. The insurer pools premiums from many policyholders and uses those funds to cover the claims of those who experience a covered loss.
So, it's about spreading risk across a large group?
Exactly. By pooling the risks of many individuals or businesses, insurers can manage and predict potential losses more effectively. That way, no single person or entity bears the full cost of a catastrophic event. This principle of risk sharing is at the heart of insurance.
I think I'm getting the picture. Now, what about reinsurance? How is it different from regular insurance?
Reinsurance is essentially insurance for insurance companies. Insurers transfer part of their risk to other insurance companies, known as reinsurers, to protect themselves from significant financial losses. For example, if an insurer faces a large number of claims due to a natural disaster, reinsurance can help limit their losses. It's a way for insurers to stabilize their balance sheets, ensuring they remain solvent after large claims events.
So, reinsurance helps insurance companies manage their own risk, just like how individuals or businesses use insurance?
Exactly. Think of reinsurance as a risk management tool for the insurer. By transferring portions of their exposure to a reinsurer, the primary insurer can take on more policies and larger risks than they could alone. It also helps in managing capital requirements and protecting their financial health in the face of unexpected losses.
I see. But why wouldn't insurers just hold on to all the risk themselves?
Good question. Holding on to all the risk can be too financially burdensome. By purchasing reinsurance, insurers can avoid taking on the full impact of high-severity events like hurricanes, earthquakes, or major liability claims. It gives them flexibility, enhances their capacity to underwrite more policies, and ensures they can meet their obligations to policyholders without jeopardizing their solvency.
That makes sense. It sounds like both insurance and reinsurance are crucial parts of how the industry manages uncertainty.
Absolutely. Insurance provides financial protection to individuals and businesses, while reinsurance offers that same protection to insurers. Both are vital in maintaining stability and ensuring that the industry can respond to both everyday claims and catastrophic events.
This is really helpful. I can see how important it is to understand both insurance and reinsurance from the very beginning. Thank you for breaking it down so clearly.
You're very welcome. As an underwriter, understanding these fundamentals is key to assessing risk effectively and making informed decisions. This is just the start, and there's much more to explore, but I'm confident you're on the right track.